Hi everybody, and welcome back to video number 2 in chapter 9. And when we left off, we were looking at an illustration of building costs. And here, as a civic gesture, Art in Bloom is hiring an independent contractor to build a museum on land it owns. The land has been used as a park for residents in the community. To obtain a building permit for the new building, Art in Bloom must commit to fund the purchase of land adjacent to the museum for a new park. The CFO asks you, as the accounting intern, to determine the total cost of the building that should be capitalized on Art in Bloom's balance sheet based on the following information. And they give you the payment to the contractor here, the additional security during the construction, allocation of overhead costs to the management team, excavation costs, cost of a building permit, funding for the cost of the land, hiring a new project manager to oversee the work for Art in Bloom, and donations to offset the cost of the land. Total net costs $29,730,000. At what amount should the museum be reported in the financial statements at the completion of the building? Let's take a look. The cost of the building should include all the costs mentioned above except the allocation of overhead costs related to the management team and the donations to offset the cost of the building. The allocation of the overhead costs is not considered a cost of the building because these costs are not avoidable and not the direct costs of the building. Donations should not offset the cost of the building, but should be reported as revenue when received. And lastly, the payment for funding the land for the new park should be reported as part of the cost of the building because the building could not be built if the permit were not granted. Therefore, the cost of the building is $31,530,000. That's the $29,730,000 less the $200,000 plus the $2 million of donations. And that comprised the cost of construction, excavation costs, security costs, cost of the building permit, the cost of the park land, and lastly, the project manager's cost. Okay, the ARO, Asset Retirement Obligation. An ARO should be recorded initially at fair value, then increased to its disposal cost over the life of the landfill. Companies use the effective interest method to increase the ARO over time with an offsetting entry to accretion expense. Accretion expense, new terminology here, is a periodic expense recognized when updating the present value of the balance sheet liability. It is reported as an operating expense on the income statement. Let's take a look at an illustration. The Hillman Company determines that it has an ARO of $100,000 related to the underground tanks for a gas station it purchased on January 1, 2025. The gas station tanks have a useful life of 10 years and are depreciated using the straight line method. The present value of the ARO using a discount rate of 6% is $55,839. What entries should you make to record the ARO and the ARO for Hillman in 2025? Okay, so to record the initial costs of the ARO, we were going to record that present value of $55,839, and the credit is going to be to a liability called asset retirement obligation. Okay. Then to record the depreciation to the building and accretion of the asset retirement obligation up to its disposal cost. Here we take the $55,839 divided by the 10 years. We get $5,584 of depreciation expense with the same amount for accumulated depreciation dash buildings. Then we have 6% of the $55,839, which is $3,350, and then another credit to asset retirement obligation for $3,350. If I go back for a second, I want to make sure that you see that we're using this discount rate of 6% here, and that's where we get this 6% in the journal entry here. Okay. Obligating events. Existing legal obligations that require recognition of an ARO include, but are not limited to, decommissioning of nuclear facilities, dismantling, restoring, and reclaiming oil and gas properties. And by the way, I did just that. Reclaimed land that we had purchased for a site of manufacture. And if you think reclaiming a land is cheap, it is not. It's very expensive. Fortunately, I foresaw that and got a disclaimer for that from the prior owner, so they paid for it. Then certain closure, reclamation, and removal costs of mining facilities. I watch a Discovery Channel titled Gold Rush, and they go and they buy some land and they extract the gold. But then when they're done, they need to restore that land to a pristine condition. And that's what they're talking about here. Closure costs, reclamation and removal costs, and then closure and post-closure of landfills. All expensive. Okay, here's an illustration of drilling platform. The Wildcat Oil Company on January 1, 2025 erects an oil platform in the Gulf of Mexico. Wildcat is legally required to dismantle and remove the platform at the end of its useful life, which is 5 years. Wildcat also estimates that dismantling and the removal cost will cost $1 million. Based on a 10% discount rate, the fair value of the ARO is estimated to be $620,920. Wildcat has developed this schedule here for its accretion expense and how that ratchets up here over 5 years to $1 million of ARO liability, and then the drilling platform depreciation expense. And you can see that we get this based on that 10% discount rate. So we're going to start with $683,000 here. And we get that by taking 10% of the $620,920 times 10%, and we add that little beauty on top of the $620,920 to get $683,012. And we go through that effective interest rate calculation, as you know how to do by now, to get the remaining numbers. On January 10th, 2030, they contract with rig reclaimers to dismantle the platform at a price of $980,000. So what entries would Wildcat make related to the ARO in 2025 and 2027, and then finally disposing the platform in 2030? So they get a little deal there. They thought it was going to cost $1 million, but they did it for $980,000. So here we're going to record the cost of the platform and the associated ARO, $620,920. Then to record the depreciation and accretion expense, here was the $124,184. Here's where we got that, right? And we got that simply by dividing 620,920 by 5. Okay, and so that's where we get our first year's depreciation expense and accumulated depreciation. And then the accretion expense is going to be the $62,092, which we calculated here. Okay, and again, the credit is to asset retirement obligation, ARO. Then in 2027, we had another depreciation expense and the accretion expense for the schedule we just did. And then finally, we make the ARO zero out by debiting asset retirement obligation for $1 million. We credit cash because that's what it cost us for that dismantling. And then we also record the difference between $1 million and $980,000 as $20,000 gain on the settlement of the asset retirement obligation. Okay, here we'll look at recording PP&E costs. The Columbia Company manufactures machine tools. On January 1, 2025, Columbia purchased a stamping machine at a retail price of $12,000. Columbia paid a 6% sales tax on this purchase. Columbia paid a contractor $2,800 for a specially wired platform for the machine to ensure uninterrupted power to the machine. Columbia estimates the machine will have a 4-year useful life with a salvage value of $2,000 at the end of 4 years. Columbia constructed a small manufacturing facility specifically to manufacture one particular accessory. Columbia paid a construction contractor $600,000 cash, which was the total contract price, and placed the facility into service on January 1, 2025. Because of technological changes, Columbia anticipates that the manufacturing facility will be used for no more than 10 years. The local government, where the facility is located, requires that Columbia remediate the facility site at the end of the 10-year period so that it can be used as a community center. Columbia estimates the cost of remediation in 10 years to be $75,000. So it's asking you, what amount should Columbia record the acquisition cost of the machine? 2, prepare the journal entries to record the manufacturing facilities and the ARO based on an effective interest rate of 6%. The present value of the ARO is $41,879. And then finally, on December 31, 2034, they pay a restoration firm to remediate the site at a price of $80,000. They want you to prepare the journal entry for the settlement. And that looks like a good place for us to stop this video. And when we return, we'll take a look at solving this dilemma. Until